Global oil markets are watching the conflict between Israel and Hamas cautiously, with prices slightly elevated from last week, but still considerably below recent highs as the brutal conflict in southern Israel and Gaza unfolds. Brent crude oil futures, one of the benchmarks for the global oil market, were trading at around $88 per barrel on Tuesday afternoon, up from $84.58 when markets closed on Friday, the day before Hamas militants staged an unprecedented raid into Israeli territory, massacring hundreds of people and dragging as many as 150 hostages into Gaza. Before the Hamas attack and the all-out Israeli response comprising thousands of airstrikes in Gaza, oil prices have been trending downward after hitting a recent high of nearly $95 in late September. McGlone joins the stage as he explains the consequences of the Middle East conflict on oil prices and general economic growth. Let's now join him and hear what he has to say. Remember to hit the like button, subscribe, and drop your comments below.
And this goes back to 1970. I'm just taking WTI crude oil relative to its 40-month moving average. What we did back in last year was synonymous with a recession every single time since the big spike in 1973. Some of us remember that. I remember the big one in 79. That's when I was a gas jockey. The big one in 1980, I was in the trading pits. And almost every single time these spikes lead to recessions. Now this year we've had a bounce, but it's also part of my big picture that we're going to see more of what's happening in today's classic responses. Crude oil's up, not a lot. It put in a high about 95 just a few weeks ago. It's trading 86 or 85 now. And we have the stock market down, bond yields down a little bit, the ones that are trading in futures. Gold up, as you mentioned. I expect that to be more of a enduring pattern, but crude oil to tilt itself back down. And Bitcoin is proving itself. It's still a bit of a risk ask when things go down. But I want to tilt over to some of the things you should expect in crude oil. Here's a longer term chart going back to 1900. And it's been in a bear market since that peak in 2008. We've had this little bounce, and if for good reason, any type of red mark means recession, crude oil goes down a lot. And again, we're on our economics call this morning, and when you see events like this, it triggers it. It adds a catalyst to recession. Remember 9/11. Remember Saddam Hussein's invasion of Kuwait. These things trigger. You need catalysts when you're already there. And when you get some fuel on the fire, that's what I think is happening today. So I want to just show you shorter term crude oil, what's happening. That's the macro big picture. So here's for traders. In the white, that's managed money net positions in crude oil. It just started to roll over. That's hedge funds. I mean, not just crude oil, all petroleum. So crude oil, Brent, and the distillates, all the ones that are really active, just started to roll over at a peak similar to November of last year. We're having a little bounce today, but this is a clear sign that managed money net positions are starting to sell out a little bit. They're very extended, and you need more of those to come in, but it's very rare for them to buy at certain levels like this. They're already way overextended long. And I'll tilt over to Bitcoin and go back to you. And this is what I could not get away from the screens this weekend. I obviously was all over it. The key thing that happens in something like this is you hit stops. And people sell stuff that they can, not always what they want. Now, this is shorter term. The stock market's not down a lot. 0.5%'s nothing. But had that big bounce on Friday, which I thought was classic clear out the shorts for a recession. And there's been so many shorts. And I know them. I see them there because they're just saying, okay, I'm either going to buy puts or T notes or hedge myself, and I see it coming. So the key thing for Bitcoin I like to point out is liquidity is still negative. Bottom line, it is negative as you look at Fed funds out a year. Now, that's actually helped a little bit. This war has actually, Fed fund futures have actually increased a little, mean yields have dropped a little, means the Fed might lighten up. I don't think that's going to happen, but it's helped. But Bitcoin's tilting lower, and I like to say it's just stuck between the 50-week and the 100-week moving average. And with liquidity still negative and beta still positive and risks for recession, and what equities do in recessions, I think the 100-week moving average tilting lower is still the more powerful force. And that's down about 29,000 now. Not saying it's magic if it just stays above there, but you need to see divergent strength. And right now we're seeing normality in this kind of environment. Back to you.
Experts have pointed out that the conflict could impact the price of oil in several ways, in particular, if it expanded beyond the borders of Israel and Gaza. The main thing we would be looking for is if disruption or conflict spread to the wider region, said David Doherty, head of oil and renewable fuels at Bloomberg NEF, which supplies strategic research to market participants. The Middle East not only supplies close to 1/3 of the world's crude, but also more than 42% of medium-heavy oil, a favorite of refiners to maximize production of jet fuel and diesel, Doherty wrote in an email. The number of alternate suppliers the markets can tap for medium oil is limited. He said Russia used to supply 22% of the world's medium crude, but has been blocked from selling on the open market because it invaded Ukraine. So any further disruption could impact prices of these fuels and particularly of medium crude, Doherty said. Mike McGlone continues with his analysis of the oil chart and its projectile in the case of any new developments.
We have a problem of exports right now. Right now, we have an excess of 6 million barrels a day. And we use Iran. Iran's been able to add 1 million barrels a day. US and Canada together, which includes ethanol and biofuels, we have 6 million barrels a day we have to export because we don't use that. That's how the world's changed from kids like us who grew up during I remember the 73, 74 crisis and the 79 wars and things. This is what's really changed. And this is why I point out it's negative for crude oil prices. It's wonderful for the US. It's bad for Europe, bad for China, but the US is a shining star in this. And that's where the dollar is no problem. Yet we're still restricting liquidity. I just want to show over a few other things. This is also a paradigm shift. What I show you in orange is total consumption of unleaded gas in this country. It's plunging. I mean, it peaked before the pandemic. I mean, absolutely plunging. I mean, I drive an electric car. It's awesome, but it's not just because of that. It's work from home. But this is total miles driven are going up. That's a paradigm shift in what's happening in the US. This technology taking over and making OPEC redundant and things like that. So also a thing I want to show you in terms of inflation and deflation. I still think we're heading towards severe deflation. Now, if oil spikes, great, maybe it goes to 100, but what's that going to do for the economy? The number one pressure for inflation, deflation is economic growth or contraction, and we're heading towards that. So I show you in white, that's just the Bloomberg Commodity Index. Every time it spikes from new highs, what I overlay was PPI collapses, and we've had a little bounce this year. It's still heading lower. It's starting to tick down for a good reason. The things we said, crude oil, dollar strength, it's unstoppable. And there's also a key thing just two more and I'm good. This key thing that's current bodies in motion is we have negative money supply. The number one thing in all markets is liquidity and money supply. It's negative. And why? Biggest pump ever is still dumping. And we have a Fed funds rate well above negative money supply around 4%. So that's what's happening right now, is that we're going to change that. Again, this is just another little deflationary thing. We've had this big pump, and the number one thing for deflation, I think, is when the stock market comes back to parity with GDP. I mean, it was the highest ever before the Fed started tightening. That's what I show you there. And CPI is just starting to roll over. You see hands? It's severe deflation. I'll end with this. Now, this is just going through a little bit of history here. This is the crude oil chart in 1973. What happened when that happened? Compare that to all the other ones. It put in many lows here. I remember 79 was when I was pumping gas, and we had headlines. We had double the price. The war in the Gulf, that put in a peak around 40 that lasted for 13 years or so. The low after that was around 10. And this peak we took in 08 is still heading lower unless we can have some kind of crisis that's just going to make it worse. So that's in agriculture too. That's just showing facts of how the world's changed since we were kids and we had to live through those big oil spikes.
As the leader of the OPEC oil cartel, Saudi Arabia earlier this year persuaded other oil-producing economies to drastically cut production, driving prices higher. This means that major exporters, including Saudi Arabia and the United Arab Emirates, currently have significant excess capacity, estimated to be up to the equivalent of 4 million barrels per day. Should Iranian oil be taken off the market, they would be in a position to close that supply gap. The question is whether they would. Our view is that Saudi Arabia, along with OPEC, will likely maintain its position until at least the end of the year, wrote Doherty. Oil prices are in a position they are usually comfortable with. However, if prices trended higher as a result of dislodged or further restricted barrels of Iranian barrels, Saudi or Russia could be enticed to produce more and send more volume to China, the largest buyer of Iranian crude. But this is speculation. Another factor that could disrupt the oil market is Treasury Secretary Janet Yellen's revelation Monday that the U.S. was poised to crack down on the sale of Russian oil in defiance of international sanctions. The U.S. and its allies have placed a price cap of $60 per barrel on Russian crude to limit Russia's ability to fund the war in Ukraine. Russian oil, however, has been making it to market at prices above the cap. Yellen told the Wall Street Journal, "We are looking at enforcement very carefully, and we want to make sure that market participants are aware we take this price cap seriously. And to the extent Western services are used, we mean business about abiding by the cap." U.S. intervention that has the effect of removing Russian oil from the market could also affect prices. All these are a lot to take in, especially while we are battling a recession and deflation, as Mike McGlone pointed out. What do you think is the best way out of this? We would love to know your thoughts in the comment section below. Also remember to hit the like button, subscribe, and turn on notifications.